where are the funding sources to support this cause in country, regionally, and globally? Where are these funding sources? Secondly, what strategies are we likely to use to access and mobilize these resources? In fundraising, we usually talk about raising friends before raising funds. Secondly, we talk about fundraising as the gentle art of teaching people the joy of giving. Are we at that stage where we are able to share strategies, instruments, and approaches that can be used by our different member states in order to raise the resources that are needed? But I also want to say that we also normally think of resource mobilization as the right person asking the right prospective donor or investor for the right reason, at the right time, in the right way. So we shift gears a bit now to having presentations that are going to help us understand how we can raise these resources. So next I want to introduce Dr. Lufeyo Banda, a national of Zambia. He earned his PhD in economics from the University of Cape Town in South Africa in 2010. He is a development economist. He has previously worked in Washington, DC at the World Bank, IMF, as a scholar and a relationship manager in the corporate division of the Standard Chartered Bank, and as a finance expert at the SADC Secretariat. In fact, Lufeyo was heavily involved in the production of the resource mobilization strategy. He is currently the Chief Regional Operations Officer in the Regional Integration Department, assisting the African Development Bank with implementation of regional infrastructure and industrial projects, the authorization of the SADC Regional Indicative Fund, among others. So let me welcome Dr. Lufeyo Banda to take us through some of the existing instruments that can be utilized to finance mega projects in Africa, in particular from the infrastructure perspective. Over to you, Lufeyo.
Thank you, Dr. Moyo. And I hope you can see my presentation.
Yes, I confirm.
Thank you, Chair. And thank you very much for allowing me to participate in this meeting and share with you some perspective on how SADC can implement a mega project by mobilizing adequate resources. Basically, my presentation will follow the following. Okay. The following will be my key outline of the presentation. I'll briefly look at the background. I'll look at the sources of funding for infrastructure. I'll look also at the principles of infrastructure which are underlined. And I'll also look at the options of financing instruments, potential sources for transport, including other infrastructure projects, and how SADC can mobilize resources for RISDIP and regional commitments. And I'll end my presentation with a little bit of some antidotes in terms of the case studies, and there will be two. Then I'll conclude based on that. I'm using, I think, a little bit of outdated data. However, I think I understand that there's about 75.2 billion worth of resources required to implement, I think, SADC projects. However, these resources which are recognized here are from the previous stamp, which was developed by SADC, and I think it informed exactly to say, look, in terms of transport, we had about 16.7 billion of resources which were required. Energy, we had about 12 billion. ICT, we had roughly about 21 billion, and water, it was about 13 billion. Collectively, those amounts were coming to about 64 billion and translating into 12 billion worth of resources which were required every year for 5 years. And if you ask me, have we performed well? The answer is no, we haven't performed well. In terms of the sources of these resources, where do they come from? ICA has done, and in fact, where I come from the bank, I think we have been doing a little bit of some, introspect in terms of who is financing the projects. Basically, I think most of the resources come from the national governments, and that is fiscus. A little bit of more resources also come from developing partners like EU, Germany, UK, USA, you name it. Other resources also come from multilateral institutions such as African Development Bank, World Bank, European Investment Bank, FW, to name at least a bit. And we've also, the biggest elephant in the room, China has been rising and I think contributing more to infrastructure project development. And we have got also the private sector, which has not been performing well. However, it has huge resources in terms of, I think, contributing to infrastructure financing. Allow me also at the same time to look briefly or talk briefly about the principles of infrastructure financing, because it's not just financing for the sake of financing. The first principle is public or government financing, government financing. Public sector lending, these resources are in public sector lending, grants, subsidies, guarantees, indebtedness may be least expensive resources you may ever get, because the money is coming from the government and at times it comes from the taxes. So it's a little bit cheaper in terms of mobilizing. Then we've got also corporate financing. This is financing to the project company or sponsor company against proven credit risk and ongoing business. And that is the fundamental underlying the corporate financing. We've also got project financing, which is limited or no recourse financing to SPVs or companies, and SPV relying primarily on future cash flows for the project for repayment. More expensive than government financing, but off balance sheet, which could be very good in this era of COVID pandemic and floods and the like, where the government might not have adequate resources. If we are looking to alternative resources, this could be one of them. Private financing may employ corporate and project financing to provide equity, quasi-equity, shareholding, and subordinated loans, grants, etc., to develop projects. And we've got blended financing, which normally uses the grants to leverage more resources from private sector or risk resources. So this is fundamentally the principle underlying the financing of the infrastructure. And just to tease it a little bit, when we are looking at public financing, what does it mean? The government borrows funds to finance an infrastructure project and gives a sovereign guarantee to lenders to repay all the funds. Government may contribute its own equity in addition to the borrowed funds, which is ideal because definitely we are not just going to give the money to the government for the sake of giving it. There should be some guarantees that the government is going to pay. And the government, for your own information, is the best instrument or institution we can lend to, because normally when we lend to the government, it's almost like risk-free, irrespective of which government is there, or even if the government had to fall, another government will rise, and I think that debt will have to be paid. And that's why the treasury bills, which are issued by the central banks, are risk-free instruments. Lenders also analyze government's total ability to raise funds through taxation and in general public enterprise revenue, including new tariffs. Allow me at this juncture just to point out one thing. Key to this when we are assessing the government does not only end at looking at these issues. We also go to IMF, its multilateral institution, to obtain a letter of comfort. Is the government, in terms of macro fundamental, performing well? Can it be sustained? Does it have adequate import covers? These are issues we look at globally because we are a developing financial institution. If I'm talking about MDBs, then the sovereign guarantees show up as a liability of government lists to financial obligation, which is also critical. Whatever the government guarantees, that is not just a guarantee; it becomes an obligation under which the government owe a liability. And briefly, there I've outlined exactly how the flow of resources move and in. The government, which is at the center, borrows the resources, let's say from the private sector or from the multilateral institution, and they are supposed to repay those resources. However, the government is not going to implement the project. The implementation of the project could be given to the private sector firm. And that private sector firm may develop, let's say, maybe a water treatment plant and or a road, and from there the government will collect the taxes. So be rest assured, each time when you're using a road, you are drinking water, we pay taxes to the government, and those taxes, they go to payment of some of the things like infrastructure projects. Corporate finance, what does it entail? Here, a company borrows funds to construct infrastructure and guarantees to repay lenders from its available operating income and its base of assets. The company may choose to contribute its own equity because definitely it wants to borrow. And in performing credit analysis, lenders such as MDBs look at the company's total income from operations, its stocks of assets, and its existing liabilities. That is very critical because we want to find out if this institution or is it company proven enough that it can retain the resources. If it is, then definitely we will look more generously and provide the resources. The next component we normally look at is the project structure and financing. Here, a consortium of private firms may establish a new project company, an SPV, for instance, to build on and operate specific infrastructure projects. The new project company is capitalized with equity contribution, and I will demonstrate this as I will give an example in my closing remarks. The project company then borrows funds from the lenders. The lenders look to the project future revenue stream to generate by the project and project company assets to repay all the loans. The host country may provide guarantees or may not provide guarantees. And I will demonstrate this again in the case of N4 project, which was developed in South Africa. Then we've got private financial structure. What does it entail? Project sponsors are often entering into collaborative structures with government, may implement infrastructure projects through corporate and project financing tools, and also providing equity, quasi-equity grants, debt in cash and in kind, subordinated debt, or shareholders' debt, and others. The project sponsor, prior to providing any of the aforementioned financial financing products to implement the project, would have executed relevant agreements with the government. And this we can see it also in the case of the Gauteng, roads which were developed. There were some agreements which were agreed upon, and I think those are long-term agreements. In terms of the infrastructure financing versus funding, I would like to mention two things here. There is a clear distinction here. When we talk about infrastructure funding and infrastructure financing, they are two different things. Infrastructure funding refers to broadly to revenue sources, often collected over a span of many years, which are used to pay the cost of providing infrastructure services. Common sources of infrastructure funding include, for instance, general purpose tax revenue, revenue from other user charges, such as tariffs, other charges or fees dedicated to infrastructure, is the transfer revenue from the government. Infrastructure financing, on the other hand, by contract, turns these revenues into capital or development of infrastructure. And common sources of infrastructure funding include concession financing, which could be coming from the MDBs, commercial financing, grants also. And thus, and this is a caveat, unless infrastructure funding issue is addressed, the financing option will continue to be limited in nature. And this is very critical because definitely we'll have to sort out that. So the previous slide which I mentioned, I think just is buttressed by this, where we're looking at funding sources and we're looking at repayable financing options, which normally leads for us to create the infrastructure we are talking about. And I will not belabor much to talk about that. In terms of, I think, the instruments, allow me to mention, I think, a couple of issues here. When we are looking at development financial institutions, they provide concession loans. We provide technical assistance. And sorry for me to interchange in that word because maybe I'm coming from a multilateral institution. That's why I'm saying we. But basically, the development financial institutions, multilateral institutions, they develop concession loans, which is long term. At times when they give a loan, that loan could be maybe 10 years, 20 years, 30 years for it to be repaid. But at the same time, it's very cheap. It's not at the market rate. And we also offer what we might call technical assistance. This technical assistance is to enable the member countries who are implementing infrastructure to ensure that they understand and they've got enough capacity to move forward with the implementation of the projects. And in terms of the instruments, these could be in terms of loans, in more favorable terms compared to other sources, important but insufficient. Insufficient in the sense that I think the multilateral institution also belabor in terms of mobilizing those resources. Then we have got commercial banks. These could provide working capital, commercial lending, short or long term. However, it's very short in most cases. And when we say long term, in most cases, it goes up to 1 year. And most of these resources, allow me to say, like I mentioned earlier, this money normally goes to the government if the government is issuing too many or too much of the treasury bills, because treasury bills are risk-free. And you may find because of the shortness or short nature under which commercial banks trade with the deposits, whereby they are using the law of large numbers, it becomes very difficult for them to lend long, let's say maybe for 5 years, 10 years, 20 years, because definitely they will be run down of the bank. And it's difficult to access these resources in most cases for long term. Then we've got what we might call financial markets. In Africa and in SADC in particular, most of them, they are embryonic. But this is where we can raise fixed income. We can use fixed income instruments to raise more resources, and we can use sales of shares to raise more instruments. Difficult to access if the country do not have developed financial markets, which is the case in SADC region, save maybe for South Africa with the Johannesburg Stock Exchange, which is pretty much better. Other sources, these are customer advance credit from suppliers. Credit from suppliers may only cover financing for specific investment. And as you can see on my right-hand side, I've mentioned to say financing project or infrastructure assets has to be paid this in obligation. However, the biggest elephant in the room is the government, where we get transfers by the government, and important but not sustainable in terms of getting more of these resources. Project or infrastructure asset does not have to pay these amounts of money in many respects. Allow me now to move on to another instrument, which was even mentioned by Dr. Moyo, where we were talking about the private partnership. This is very critical. And according to the IMF World Bank, PPPs refer to arrangements where the private sector supplies infrastructure assets and services that traditionally have been provided by the government. What is the biggest difference here? The biggest difference here is when the risk is owned 100% by the government and the government develop that infrastructure, you find that that infrastructure is purely public. However, when you go to the other extreme, whereby the project is purely owned by the public, by the private sector, and the risk is all embedded within the private sector, then that project is private. In between, and as you are moving towards the private sector component, you find that we have PPPs. That is where the risk is being apportioned more to the private sector. And I think that is good because private sector, they are more, I think, agile, and I think they are able to think outside the box. And to buttress this point, the second slide talks to this issue of how is the allocation of risk in terms of sharing, where you can see on the top, you have got where you design, build, the contractor builds, and everything is done, and the risk is borne by the government. That is almost purely public. But when you come down where you have more or less pushed the risk away from the public, then definitely that becomes more public, private partnership. And I think you are more or less moving to whether you are selling the entire asset. So those are the few dynamics you can adopt to that. What makes this be a little bit more, much better? PPPs have been known to 180% on time in terms of completion of the project and on budget. However, when you're looking at conventional way of preparing the project and developing the project, they are on time 30%. On budget, it's less than 10%. That in itself, the distinction is what allows many people to go the route of PPPs to ensure that at least they can tap into efficiency aspect of implementing the project. In terms of SADC, and I want to drill down a little bit on this. What are the key challenges of SADC mobilizing resources for these infrastructure projects we have been talking about? And I think as I was listening to the previous speaker, it reminded me of one thing, which is a little bit sad, but I think it's something which is not insurmountable. And I think SADC needs to rise to the occasion and look at the figures which have been presented by the previous speaker to be, I think, a challenge, but a challenge I think which we can win within the SADC region. First and foremost, poor macroeconomic fundamentals. Due to COVID and other, other issues, you find that at least SADC have not been doing well. I think some countries have overborrowed and they cannot even go to the market. Countries which were able to go to the market at one particular point in time, they went to those markets, I think, without really thinking too much about exactly what they were getting into. And even in the negotiations, they never negotiated properly. And I think when they came out, I think that impacted badly on their macro fundamentals. Inflation could be very high, issues to do with the debt to GDP very high. All those things I think have impacted on this. And I think we can see some of the countries, I think they are almost in debt, and I think whereby they cannot pay. Second is lack of project preparation facility instruments. Yes, we've got SADC project preparation facility, which is being hosted by DBSA, but let's be honest. If we are going to talk about infrastructure or regional investment of 57 billion, according to World Bank study, it articulates that 10% of that amount should be for project preparation. So by all means, if we are talking about 57 billion, then we're talking about almost 5.7 billion to be, the money we should be allocating to project preparation facility. But let's look at our project preparation facility. How much is there? There is almost zero. We're talking about maybe 10 million, we're talking about 20 million. And what is that going to do? Nothing. And also at the same time, the project preparation facility is currently operating in Africa, and I did a study on that. They are very fragmented, embryonic, a study which was recommended by the G20, and it recommended that we should come up with the big fund. It was thrown out of the window. That is the way we could have gone to prepare most of these projects. But allow me just on this project preparation facility to mention one thing. One biggest challenge is when you are dealing with regional projects, they're not like national projects, whereby some minister can wake up and say, yes, we want to implement this project, and we are able to implement it. Regional projects, I think they have got their own dynamics. And I will throw an example here. Let's look at Kazungura Bridge. Kazungura Bridge was developed by Botswana and Zambia. What does it entail? Botswana may want to go and borrow market from AFDB, that is the bank. Zambia may want to borrow money from ATF. What does it imply? There are two instruments there. One instrument is saying you can borrow at market rate or almost market rate. The other one is saying is you can borrow at the very concession rate. What does it entail when you are building the common good? One country may feel undermined and may not want to move into that. So regional instruments, project preparation, they become very key. And lack of innovative financing instruments such as SPVs, infrastructure, and industrial bonds, this has a bigger problem, I think, or it creates a big roadblock in terms of how we implement the project. In the region, we don't have these instruments. And yet, I think, and I'll demonstrate assets under management, we have almost about 3 billion. You find that these resources, you cannot even talk about it, we cannot even mobilize them. However, I think that's where we should be moving to. Then there is also embryonic capital markets. I've alluded to that, and I will not tell much and waste much more of my time to talk about it again. And also there is lack of proper regulatory policies for financial sector and non-banking. This is very critical because you find at times our capital markets, they will take all the resources we have and invest it in Europe.
I'll ask you to start lending, Banda.
Hello?
I'm saying I'll ask you to prepare to lend.
Yes. Okay. Then I'll move a little bit quick. Then you see all this, and there is also lack of land or the fund, which we should be able to move. Then, in terms of the resources, we have got huge resources in SADC. For instance, assets under management. We are talking about 300 billion or 500 billion within Africa, and within SADC, I think it could be over 300 billion. We could mobilize more resources for this, and yet our pension funds, they do not put money into the infrastructure projects. Then we have got a lot of resources from the pension funds, and I think we need to look at that and I think see exactly how these institutions can provide more resources. Now, allow me just to talk about, because Dr. Moyo has told me to land, I'll give you one example, and I think I will not belabor much to another example. And I'll bring one example. I will not talk to the toll road in Santiago, but I'll talk to the toll roads which was done, but they are very similar, which was done here in South Africa. This was the Maputo road. It was a 620 million N4 road between Mozambique and South Africa. And to ensure that this project was implemented, and you can read most of the things, the following is what was done. I'll go specific to this. An SPV was created, and there were sponsors, and these sponsors were Stocks Banks of France, and there were also non-sponsors who were in the name of South African Infrastructure Fund, to which African Development Bank puts a lot of money. They were also R&D, asset management, insurance, and pension funds. They also provided 60% equity. Once this was realized, they were able to go to the market and borrow from GFI, DBSA, commercial banks, pension funds, who were able to bring in the resources in terms of the loans which they wanted. And the two countries provided what I might call the guarantees, though they were not even necessary and they were not used. So you could see this has been very much a project which has worked. And I think each time when you are traveling on N4, you can, I think, be rest assured to say it was prepared using this type of a model, which SADC can replicate. What were the challenges for this? The project faced unique challenges because of its cross-border nature, as well as future traffic flows in Mozambique, which were not that good at that point. And based on this, they were accommodated in one or another by South Africa. And 35% of the total of the project cost fell due in Mozambique. However, these were accommodated through the innovative ways under which they went through this. There was a high level of political will. These were the key lessons. Two governments jointly guaranteed the SPV. Concession agreement included innovative solutions to focus subsidies, which was very critical because Mozambique would not afford at that point, but they were able to bring some resources from South Africa and cover those until Mozambique part was up and running. The regulatory framework in South Africa allowed the pension funds to invest in investment funds such as South African Investment Fund, and which subsequently also invested in this instrument. Internal risks such as political and regulatory were also de-risked by what the South African government did to ensure that at least they were able to move forward. In terms of, I think, these issues lessons, I think I will not belabor much. I think you can read them. I think I'll share the slides. The only point which I would like to mention at the end is that through these type of mechanisms, innovative financial instruments, I think you can go a long way to mobilize resources, I think, which could go a long way, I think, to fund this project we are talking about. But what will it take? Two things, and I think I'm moving away from the slide a little bit. Two things we must pay attention to. One, let's come up with the SADC Regional Development Fund. The SADC Regional Development Fund can create these innovative instruments, and they will enable the investment which have been alluded to the tune of 57.2 billion to be easily implemented. Sure, I think I've taken a little bit of time, but I think I stop here.